orange screen right about now. Excellent. So happy to have you all here. Thank you for taking time out in your morning, afternoon, evening, whatever time it may be where you're at. We're going to cover a number of indicators, setups, principles that I have been using throughout my entire career, whether that be futures, forex, stocks, ETFs, options. This is the foundation of everything that I do. So again, super excited for you to be here. And the topic today is volatility. So volatility and confusion. All right, we are good to go. Excellent. All right, so volatility is confusion. I think one of the things that a lot of people are experiencing right now in this market is the confusion of whether we're going to continue higher, whether we're going to chop, all the bearish talk that's out there. Is the market going to be able to overcome that? Do we continue to bounce up? We've had a very sharp V bottom that all of us have witnessed since the end of 2018 to 2019. We're just trying to get ourselves aligned for what we think 2019 is going to bring us, get our investments in line, getting our trades in line, getting our watch lists and everything. So how do we handle all that confusion? Whether it be GDP dropping, 3 quarters in a row now, whether it be the future of oil prices, the future of the FOMC, how do we differentiate the signal, which is what we live for as traders? What is that signal versus the noise? When do we know when to stay out of the market? Signal versus noise. How do we recognize some of the chop that we're seeing in some markets? Some of you might have noticed the chop that we're seeing in the US dollar right now. Some of you might have noticed the chop we saw recently in Amazon. Where is that edge? So again, signal versus noise. Going to be a big topic we'll talk about over the next hour or so. Recognizing the chop, I'll be sharing indicators with you that will help you understand how to differentiate. And amongst all this volatility, all this confusion that is out there right now, or even concern, where is our edge? Whether that be a market that's trending or whether it be a market that's maybe having a difficult time getting out of its own way, like Facebook. All right, a lot of you have been looking at, or a market like the dollar, or a market like gold. A lot of folks saw what happened in gold recently. So a lot of whipsaw action, absolutely. All right, so the most common account killer is basically hidden in the misreading of market psychology. So what does this mean? And think about this for a moment. If you misread market psychology, if you misread what the market is trying to message to you, what is that, by the way? It's the trend. Whether the market's moving higher, whether the market's moving lower, whether it's consolidating in a channel, or whether it's moving in a wide chop, everything that has to do with market psychology, and I'll tell you what, right now, market psychology, behavioral finance, these are some big time buzzwords that are out there right now. But you know who really started this about 100 years ago? Charles Dow and Dow theory. This tackled this back in the early 1900s. To me, Charles Dow was really the first person who brought this behavioral finance or understanding market psychology into technical analysis. He said, hey, there's a psychology to the market, and it's our job as traders to be able to understand what the market psychology is and trade respecting that. There's actually 4 different market trends. We'll talk about that here in a little bit. But if you're starting off a trade without identifying what the market psychology is, which is really trends to us, then right away you've probably reduced your trading probability to less than 50%, because you're really guessing now. Now you're just throwing darts at a board, all right? So trends actually reflect psychology. If we have an uptrend, obviously there's a certain psychology, a certain narrative, a story that's running around in the broader markets. If we have chop, again, that's a different story. So we have greed. That's an uptrend, gang. Whatever different markers we want to measure greed by, whether that be a drawdown or demand for crude oil in inventory numbers, whether that be an uptrend in equities where people are tripping over themselves, as we saw for some time, that's what's known as the FOMO, fear of missing out. And folks feel that they're going to miss out on the continual move higher. That's greed, right? What about fear? Well, fear is what we saw last October, what we saw last November. Where is the market bottom? Why is the market selling off? Why are companies guiding lower? Why is GDP falling? Why is the FOMC continuing to hike rates in this environment? That caused fear. We know what happens. But how quickly can you identify greed? How quickly can you identify fear? That gets us right back to market trends. Confusion, I think we're kind of in that phase right now, where there's some hesitancy to the upside, there's some hesitancy to the downside, and the market has a difficult time clearly making moves, gaining traction in either direction. That's confusion, and that typically is where we see volatility. Now, there's something that I love. There was a great article that I read not too long ago that talked about the difference between speed and velocity. Speed and velocity. And I try to keep this in mind when I'm watching price action. Speed is this, right? It could be really fast. That could be 100 miles an hour, but that's speed. Velocity is this. Velocity is this. Moving higher, moving lower. Direction. What differentiates speed from velocity isn't acceleration, it's direction. We don't need speed. We don't just need volatility. What we need is velocity. We need a direction. Higher or lower, doesn't matter which. And this is something that Charles Dow addressed, again, 100 years ago. And it is the touchstone of everything I do. In fact, fear, greed, confusion, and no opinion or waiting, that's a channel. That's sideways action. That's the market contracting. It's actually too scared to move higher or lower. It's just waiting to see what happens next. That doesn't happen in the market that often anymore. True consolidation, narrow channels, they are pretty rare, but they're pretty magical when we get them. The trick is, how do we identify these? So the bottom line is this: would you like to have strategies that are effective in the current market environment, whatever it may be? Right? We know there's not just a single environment. We know there's potentially four that are hallmarked by those four psychologies: that greed, that fear, the confusion, or the waiting. So that means we really need to understand what psychology, and then we're going to have a strategy that we can use in that environment. Would you like to know how to find and trade opportunities in volatile markets? Again, differentiating speed, which is just fast movement, versus velocity, which is directional. Realize that directional markets, up or down, are our best friends. In fact, when we're looking at the best kind of trends, and some of you may not realize this yet, but I think as you evolve as traders, as you witness more sell-offs and more markets that are transitioning through the chop, through consolidation, uptrends and downtrends, you'll realize this. Stanley Druckenmiller was asked what his favorite kind of trend was. For those of you that don't know who Stanley Druckenmiller is, he's probably, and I don't think you'd get an argument, the greatest trader ever. I'm not talking investor, I'm not talking hedge fund guys, I'm talking flat out trader. Most people agree he is the greatest trader in history, okay? Maybe there might be some others that are upkeeping that rare air, but when they asked him what his favorite type of market was, it was a trend. And how many of you would be surprised to find out it was a downtrend? He said he's made most of his money in downtrends. So again, we really want to be able to not fear downtrends, be able to capitalize them, but still take advantage of the uptrends like we've seen since January 4. All right, so there are three ways to trade volatility. And again, understanding direction, versus directionless markets versus choppy markets. That's a big deal here. That's one of always the fears of volatility. But there's three ways to trade volatility. We can day trade it. I'm going to show you some examples with that. I'm going to follow the trend. And we're going to capitalize on the chop. So we can day trade volatility. And what's the advantage of day trading something? We're limiting the exposure we have to the market. Realize that the very first kind of trading that existed back when Wall Street was a field next to a big old wall to keep the redcoats out, right? We had day trading. There was no way to keep accounting. Folks went to that big old field and they kind of haggled and traded and went home. Day trading was the first kind of day trading, or day trading was the first kind of trading, period. All day trading is, by the way, is that at the end of the session, you don't have a position, what's known as going home flat. Right? And day trading really is a strategy that's ideal for environments that you're concerned what we could deal with the very next day. You know, what is the unknown? What is the new US-China narrative? What is the new news about, you know, whatever we might be fretting about? You know, it could be the FOMC. Maybe Powell puts his foot in his mouth again. Who knows? But you day trade to avoid those uncertainties. We can follow the trend. As I mentioned, that trends are absolutely the easiest type of environments. They're the environments that have the highest margin for error. You can have kind of a bad fill in a trend and still be rewarded because at least you're moving with the flow of the river. If I follow the trend up or down, that's going to be some of your best environments. I would tell most folks to prioritize trends. Can you trend trade intraday? Absolutely. You can have a trend on a tick chart. You can have a trend on a 1-minute chart, right? So trends don't have to be end of day position trading. Trends are simply, can we see the flow of the river and can we hop on with the flow? The opposite of that is chop, right? And I don't want you to avoid chop. I don't want you to fear chop. I don't want you to fear any kind of market, but I do want you to be able to identify it. That's step number 1, and then capitalize on it. So being able to differentiate when you want to keep a more nimble approach, day trade it, follow the trend because there is one, not that we're forcing the market to give us higher highs or lower lows, but we can actually identify a trend. And then also the antithesis of a trend, we capitalize on the chop, a non-trending market. So some of you might know that the indicators that I use, a lot of you, this will be a terrific review. For others, this is the first time. And realize that some of these tools are going to be different than what you've probably used before. But if you've been struggling with the market, let me tell you this. Every tool that I'm going to share with you, the indicators, the clarity, the entry, what I call the ICE approach, every tool that I'm going to share with you is going to work with what you're using right now. It doesn't supplant anything. It only supplements. Anything you're doing now, any kind of strategy, any kind of asset class, futures, of course, Forex, whatnot, is going to benefit from understanding whether we're trending or chopping. And the tools that I'm going to share with you will reveal that to you in a very simple way. All right, so how is ICE going to help you with your trades? We're going to help find the most effective method for entry because, and maybe for the first time in your career, you're going to be picking a strategy that's the right match for the underlying environment. I like to use a golf analogy here sometimes. I know a lot of you probably golf. If you tee the ball up, getting ready, you don't take the putter out. The putter's a perfectly good club. It's just not the right club for the job. You're on the green, you don't take out the Big Bertha. You don't take out your driver. Again, great club, wrong application. So I'm not here to tell you that certain tools are wrong. You can use whatever tools you'd like. What I'm here to tell you is if you can take the tools and apply them at the right time, you are going to exponentially improve your analysis and your results. I can't guarantee much, but that I can guarantee you because you'll simply be taking the right club out of the bag, which makes a huge difference. You're going to base your entry strategy on the current market trend, right? We're going to clarify the best times to trade and the best time frames to prioritize. Two different things. Different times of day present different opportunities. Different time frames also present different opportunities, and they present different risk-reward ratios. Let me touch on day trading for one moment here. Day trading is a terrific type of approach for traders who want to risk less in the market. They don't want to risk as much. They want to be nimble. If you have a low risk tolerance, day trading is a very effective way to manage the market. You want to know when to sit on the sidelines. So much so that you really want to do not trade watch list. Everyone has watch lists. Everyone knows they want to engage the market. But as Jesse Livermore said in Reminiscence of a Stock Operator, and if you haven't read that book, please do, he said his money was made by sitting on his hands. And that has been echoed by many, many traders over the decades. Knowing when not to do something, right? Knowing when not to do something. So that is a big part of it. You know, I was just watching, for those of you that are football fans, you know, we're getting ready for the draft and all that good stuff. Think about a great quarterback. What do they know to do? They know to take the sack. They know to throw the ball away, right? It doesn't mean they're always throwing down the field. I love sports analogies, so forgive that. But you got to know when not to really engage the market. If you can figure that out, again, life becomes a whole lot easier. We want to be proactive with order entries. We'll talk about the kind of orders that I use. I almost never, I don't like to say never and always, but I almost never use market orders. I always want to know where my price is going to be, and I want to use a limit order or I want to use a stop order. So we'll talk about proactive entries as well. So stick with me here. I know this might be a lot. I've thrown a lot at you in the last 17 minutes or so, because this information applies to any market, any time frame, gang. This isn't just about day trading. This isn't just about position trading, futures trading, options trading. I've traded crypto with the information that I'm going to share with you. I trade Forex with the information I'm going to, and these are scary markets, right? I trade stocks this way. I manage my investment portfolio with these kinds of tools. And of course, yes, I trade futures and futures options with these tools as well. And these are the tools that I've developed, helped develop. I'm going to share with you Grab, Wave, and another tool that some of you might be familiar with, some of you may not, but it's another tool that's related to the philosophy of the Grab candles and the Wave. These are the tools that I've been using for 30 years. The consistency in these tools for me is, one, I know visually what the market's communicating to me, and I trust these tools. They've seen every kind of market imaginable. Every kind of bubble, every kind of crash, you name it, these tools have taken me through it. So I trust them, they're battle tested. All right, and we have some goodies for you at the end of the webinar. Like I said, this session is recorded, and we got some goodies coming up later on. All right, so what is ICE? ICE simply stands for indicators, clarity, and entry, which is synonymous with strategy. You know, how are you going to enter the market? So let's start off with the indicators. For those of you that are brand new to the way that I trade, Grab candles are something I developed in order to understand what Charles Dow talked about, like I said, about 100 years ago. Understanding uptrends, downtrends, choppy markets, and sideways markets. Now, that might sound like something that you'd think someone would have decoded already. But believe it or not, when I was looking around at all the indicators, and there are hundreds, if not thousands of them out there, I could not find a single indicator that would help me, one indicator that would help me identify what the market trend was. Sure, there were indicators that would help me find dynamic support in a trend, or overbought or oversold levels, or momentum, but none of them would say, look, this market's in an uptrend, this market's in a downtrend. And if they were really lagging, like say the 20-period exponential or simple moving average across a 50, or a 20 crossing a 200. They would get me to the party so late that I would miss some of the best parts of the move. So I knew those longer period moving average crosses, while certainly would get the notice of broadly Wall Street and Main Street, they got me into the trade too late. I needed something quicker. So after a lot of testing, I developed Grab candles. And they're really built upon the 34-period exponential moving average. So when you look at Grab candles, and we'll look at some charts here today, you're going to notice that I've got green candles, blue candles, and red ones. There's two shades of every color. The lighter shade of green or blue or red is an up close to kind of keep that traditional Japanese candlestick interpretation. And the darker shade is the down close. Okay, the darker shade is the down close. And again, gang, this should not supplant anything you're doing. If you love candlesticks and candlestick patterns, this is not going to actually, it's going to make them better, quite frankly. It's not going to change that at all. It's going to make all of this better. So the first thing is, we ask ourselves, of the Grab candles, which color is dominating? Let's take a look at gold here. I'm going to bring up gold into our view. So this is a daily chart of gold. By the way, gang, all the examples I'm giving you are recent examples. These are all trades that we've done in the chat room. Okay, so these were alerts, these were on the spreadsheet, these were on premium videos. Many of you probably already saw some of these trades. This should actually bring a smile to your face to see what we've done with gold. For those of you that are looking at this for the first time, let me kind of run through this chart with you. So the color of the Grab candles makes a big difference. Early on in the trading that we were doing in gold, we had a mix of colors. We had a little bit of green, a little bit of red, a little bit of blue, and you can see the markets are moving sideways. Now, unless I see steady green and higher highs, I'm going to be very hesitant to buy pullbacks. I'm be very hesitant to buy pullbacks. And so let's talk about what we did, like the last 3 trades here. I won't go through everything, but let's talk about the last 3 trades here, which would be basically here, here, and here. Okay, what are the last handful of trades we had? At this point, notice that the market was moving higher, lots of green grab candles. We pull back into that little highlighted area that I show you right there. That was one of our first buys. Now, why would I buy there? Because the candles were green. They're telling me it's okay to buy because we're bullish. Simple as that. Same thing here. And then, by the way, you might say, well, what happens if the trend changes, Ragh? How quickly can you find out? Right here. That's how quickly I can find out. I can right the boat, if you will. I mean, for a moment there, it looked like the whole trade was over, right? A lot of folks, number one, bailed on the long position in gold, or they got short, which I can't tell you what a big mistake that was, because just a little bit below that breakdown was another great opportunity to get long. And by the way, like I said, this is today's chart. Guess what we're getting ready to do again? We're getting ready to fire this all over again. And for those of you that are wondering, this may not look like much on the chart. This is a move from 1286 to 1326. 1286 to 1326. Yeah, that was a really nice move higher in gold. That's $100 per point, gang, from that oversold buy to that level right there. And all of this was made possible because I followed the color of the candles, the grab candles. All right. It's moving on with some of the indicators, again, reading the direction of the market. Let's take another look. We'll take a look at bonds here. Bonds doesn't look exactly like gold, but it sure does look familiar, but it's a cleaner uptrend. So bonds were a market that started to look like a very nice uptrend. Start getting all the green candles. Even back in here, it was a pretty early look at a bullish market. But as soon as I get those consistent green candles over and over and over again, here's one thing that's really important. You stop looking for shorts. Remember I said it's really important to have a do not trade list? Sometimes a do not trade list means don't trade a market in a certain direction. How much easier is life when you realize that overall, I just want to be positioned long, and you look only for long entries. That simplifies the trading process. If you're always looking for a long or a short, by the way, I don't believe the mental transmission, our mental transmission, works that way. I think it's much easier for the brain to say, look, I'm heading north on the highway. It's just easier for me to navigate around the cars as I'm heading north, as opposed to, well, I want to head north, but maybe I'll get off in this exit and head south for a little while, but then I'll get back on and head north. It just doesn't work that way. I think our mental transmission as traders works better when we have a bias, when we have what I call a directional bias, okay? So at some point, a do not trade watch list can be as simple as no shorts, right? And every pullback, as long as we're predominantly green, presented another opportunity. Now, you might say, well, Ragh, what about those blue grab candles? Those blue grab candles tell us a lot. I won't be able to get into all the details here, but I'll tell you more about how you can get a little bit more training on this and see me use this in a live market environment. But yes, these blue grab candles do tell me something. And what they tell me is it makes a whole lot more sense to perhaps be a little bit more conservative on the buy. But again, follow the color of the candles. They're absolutely going to help keep you out of trouble. They're going to help you identify which markets have better structure, and they're going to help you identify the direction. Now, you might have noticed I had some moving averages on those charts. Those moving averages and the color-coded candles work together, and they're called the 34 EMA wave. Back then, I just gave things very basic names. I didn't give them cutesy names because it was just me in an office trading my face off, many decades ago. So the 34 EMA wave is simply the 34 period exponential moving average. I've got one on a high, a close, and a low, and they each have a color. So those 3 moving averages you see traveling across my chart are how the grab candles are plotted. And these moving averages by themselves create a really interesting zone in a trend for pullback buys and bounce shorts. So let's take a look at how we would read the moving averages. And I'm going to take you back over to, we'll take another look at that chart of the bonds. And I'll show you how we use those moving averages. So there are other tools that we can use to understand where support and resistance are, but within the context of a trend, moving averages are some of the best and easiest places we can recognize support and resistance. And these are exponential moving averages. Again, all set in the 34 period. The difference is the high, the close, and the low. That's why there are 3 of them, and they track together, as you can see. So when we pull back into this zone, this is one of the easiest zones that we can identify to place a limit order to buy. Now, a lot of traders might have looked at this high, and I remember this time in the chat room really vividly, because here we are, knocking on the door of 148 bucks, and it looks, or 148 on the bonds, and it looks like bonds are just going to take off for the moon. I said, look, we can't buy at the top of the range. The risk reward is too great. It doesn't make any sense up there. We need to wait for a pullback. And the FOMO, you talk about fear of missing out, the FOMO is going crazy up here, right? The FOMO monkey, if you will. But we have to shut it down and say 2 things. 1, the risk reward simply does not work up here, so I won't put myself at that kind of jeopardy. And number 2, healthy trends correct. And lo and behold, that's what happened. The kind of entry that you get in this area is a better risk reward. And you might say, well, Rog, what if the market doesn't pull back? We have other tactics we can deploy, but more often than not, gang, over 30 years, I will tell you, healthy trends correct. They may not correct as often as we'd like. We can't dictate how often these corrections happen, but when they do, and when you're ready, and when you can identify the zone, you can very comfortably place a limit order, and you wait for the market to come to you. All right, that's how you let the market not prematurely age you, right? You wait for let's use a baseball analogy. Today was opening day, right? Let's use a baseball analogy. Every great hitter, and when you're trading, you're kind of more like a hitter at bat, right? Every great hitter knows what their pitch is, and they wait for that pitch to sail across the plate. And that's what this is for us, okay? All right, so clarity. Now, this one might be a new tool for some of you. I know for others, you're very familiar with this, and this is a kind of, I'll call it a recent addition, but it's really not. And you probably heard me talk about propulsion dots, follow the dots, how many dots. And this tool actually is very related to the wave. It's a moving average based tool. It's actually a moving average replacement tool. And I think you're going to like this one a lot. For those of you that have never seen this, all these tiny little dots here are what's known as simpler propulsion. Amazing tool that allows you to replace certain exponential moving averages with the simpler propulsion, and allows you to take advantage of moving average crosses. So a lot of you love moving average crosses, say an 8 crossing a 21 or a 5 crossing a 34 or whatnot. If you like moving average crosses and you like moving averages, this is the evolution of moving averages, gang. They use moving averages, but it's the kind of secret sauce, if you will, is how do those moving averages interact with price to reduce false breakouts and to give us cleaner signals. One of the problems with moving averages, gang, is that they're not self-correcting. They're always going to be on your chart, and they're always going to basically, leaving their footprint on the chart, going to be a visual distraction. You're going to think, well, if the price action's interacting with the moving average, maybe I should do something at that level. And I think experience has taught us, if it hasn't, it will, that every moving average is not one that you should react to. So the way that we solve that problem here at Simpler is we derive these simpler propulsion dots. And what they do is they plot over the space that, say, a 13 exponential moving average. I mean, you can set them to whatever you'd like. I like 13, that's the one in yellow. You can see there's a 21 here in green. These dots right here, you'll see a couple red ones. That's actually the 8 exponential moving average. So you'll notice they come and go. that tells you that if there aren't any dots, there's nothing to react to, is there? There's nothing to distract you. But when the dots appear, they're telling you that moving average is now a valid consideration for support. And look how well these lit up yellow dots have acted as support within the context of this uptrend on the 1 minute Russell. So I showed you some daily charts earlier. I don't want anybody thinking that it's just about daily charts. Here I am using the same exact tools on a 1 minute day trading chart of the Russell. And by the way, this was today's chart. This was a trade that we took today. And the propulsion dots not only let me know that the market was accelerating and that the 8-period exponential moving average would be in play as support, it actually allowed us to buy 5 minutes after the bell, 15 minutes after the bell, and take advantage of nearly all of this movement higher. And that's how powerful understanding when the market is giving you certain moving average crosses and whether or not to even consider that moving average is valid, that's how easily we can interpret that. So the false breakouts of moving average crosses and using the quote unquote wrong moving average, that really is going to be absolutely minimized, okay? Propulsion dots are one of my secrets to clarity. And that is understanding acceleration, or when the market is putting its foot on the gas pedal. That's really what it is. So the market's going in a direction. You already have, say, green grab candles or red grab candles. We already have a direction, right? And then those dots appear. That's like already cruising down the highway, say at 60 miles an hour, whoever might do that. And now you're flooring it and you're doing 70 or 80 miles an hour. How do I know when that acceleration is going to happen? Those moving average crosses and those propulsion dots are going to be your cue. Okay, this is one of my favorite tools, the propulsion dots. So let's talk about the chop and volatility that's such an account killer that I mentioned earlier. When you've got a mix, so we talked about red and green environments when the market's trending. Best environment you want to look for, that's where your primary watch list should be coming from. But when you get a mix of red and blue and green grab candles, when you don't have, say, the consistency of the yellow or green propulsion dots, very likely that you're dealing with chop. Now, there's two kinds of sideways markets out there, gang. There is a sideways, very narrow sideways market, and there's much more wide sideways market. So this is going to be more consolidation, narrow, and this is going to be more congestion, also what's known as distribution. Knowing the difference between the two is the difference between knowing when to play a breakout or breakdown and knowing when to fade or sell short at the resistance level, right? You'd sell short, or whether to buy at support. So it's a really big deal that you know the difference between chop versus a channel. And the grab candles will absolutely be what will alert you to them really simply. The more, and here, if you want to write this down, think about this for a moment. The more blue grab candles you see, the more blue, the more neutral this market is, the more you're probably looking at a channel. Okay? The more you see a mix of blue, red, and green in quick succession, chances are you're looking at that choppy market. Overbought, oversold, chop, selling the ceilings, buying the floors. Okay, and the big deal, the difference is in a narrow sideways market, I'm actually looking for momentum higher through the ceiling or momentum lower through the floor. So it's a pretty big deal that you know the difference between these two, and the mix of grab candles is going to be what the characteristic of chop will be. But more blue, that's more of a channel. Okay, big difference there. If you take nothing out of this discussion, but this slide right here, I'm telling you, this alone will keep you out of so much trouble, because it's one of the biggest mistakes a lot of traders make. They don't, one, know how to identify choppy markets, and two, they don't know the difference between channels and chop. So the grab candles alone will help you identify that. All right. Okay. So let's talk about entries here, strategies. All right. And what does my daily process typically look like? And we'll take a look at a few more examples. By the way, how are we doing so far, gang? And I will tackle some questions towards the end. So let's just kind of get to the bulk of this. I'll be happy to take some questions, look at some charts with you all? All right. So here's what the daily process looks like. All right. So when I start my day and I get into the chat room and we're taking a look at the markets together, typically the night before or the spreadsheet in the members area, we have a watch list already going. We already know what's on our do not trade watch list. And we want to know what kind of events are on the economic calendar, things like that. So first thing is, what are the symbols in play today or even this week? I want a pretty finite list. I don't want to be scanning through dozens and dozens and dozens of symbols every day. It's exhausting and it's going to take away my focus from what the best candidates are going to be. So the first thing is, what do I want to trade? Like I said, prioritize the trends. How easy is it to prioritize the trends? Find the green, find the red grab candles. That's going to be one of the easiest ways to determine what you want to trade. The next thing you want to do is identify your hot zones. That's economic data, gang. That's Fed speak. That's central bank. That might be, for example, we find out that one of the, maybe a politician's going to be hitting the airwaves, right? Maybe it's POTUS, maybe, whoever it may be. There's going to be an event. Sometimes they're scheduled well in advance. Sometimes they're unscheduled, but hot zones are going to be scheduled events. Think earnings, think GDP, think non-farm payroll, think FOMC speeches, etc. We always want to be looking at the economic calendar and be aware of these volatility events. Because again, in order to handle volatility, we have to recognize what it looks like. That's what we've talked about so far. But we also have to recognize when it might kick off. And the calendar is a perfect way to understand that. I think any of us looking at an earnings calendar for our equities know that that's a volatility event. My favorite calendar, by the way, is at a site called Forex Factory. Don't freak out. It's not about Forex. That's not what I'm telling you to do. It just happens to be an excellent global calendar. You really need to look at a global calendar. What kind of data did we get out of Europe, out of Asia, out of China? Because we're going to inherit a lot of that as the markets open in the US. So you want to look at a global economic calendar, and Forex Factory has one of the best ones that I use. So that's a big part of timing, all right? It's a big part of timing. What's the impact of the release? We know volatility is coming. Another thing we do is we start looking at the price movement range. Maybe it's the current distance from price back down to the 34 EMA wave. Maybe it's going to be something I call price movement ranges, hourly and daily price movement ranges. What's the typical range of the market? Some of you might use an average true range or an expected range. There's a lot of ways to figure out what the price movement ranges are. We use a handful of them in the room, but that's something else you really need to be aware of. How many points, ticks, etc. does your symbol tend to move on any given day? There is a historical tendency for certain markets to move a certain amount of pips, pips, points, ticks, you name it. We want to know what that is. That's something that I see a lot of traders overlook. I think that's why studies like an average true range and looking at expected ranges are such a big deal, because to not know what the characteristics, what the personality of your symbol is, it's going to affect the way you place your profit target. It's going to affect the way you place your stop losses. You really want to work within sort of the price movement range of that symbol, and they're not the same for every market, right? Every single market has a rhythm throughout the day and has a certain number of points it tends to move. Then I talked about using limit orders. Gang, we don't want to live by twitchy little market orders. If I know where the wave is at, if I have a pretty good idea where price movement range is at, then I have the luxury of being able to, what I say, park a limit order. I can be proactive. Again, I want to know what my pitch is, right? I need to see my pitch sail across the plate. I want to see price action come to me, right? So that's where the limit order does its job. I put that order out there at the price that I think we're most likely to see for that breakout, breakdown, correction, retracement, reversion to the mean, what have you. I put a limit order there. By the way, if it's a correction trade, if the market's going to move down to whatever your support level is, I would use a limit order. If you have a market moving sideways and you think there's going to be a chance for a breakout or a breakdown, what I would tell you to do, or any kind of momentum environment, you want to use a stop order. Okay, now a lot of you might think, whoa, stop order, Rog, isn't that for getting me out of the market? No, gang, stop orders are actually just a market order with a price trigger. So you're telling your system that at a certain price, you want that trade to wake up and get you in at the next best price. A stop order is a market order with a price trigger, okay? So notice I'm being very specific about which price I want to trigger my entry. I'm making the trade come to me, okay? All right, so how do we neutralize account killers? We talked about how to identify market trends, how to identify chopping markets versus channeling markets, how to use moving averages to create zones for corrections, how to use moving averages to help even identify trending markets. So there's a few other things that we want to add into the mix, but they're really basic things that when you keep up with the narrative of the market, sometimes that means data like the economic calendar. Sometimes that even means certain macros. We talk about all that. I keep you up to date on that. By the way, and I don't want to get too inside baseball here with this, but one of the reasons we have been so successful being long in gold, right, is that we haven't subscribed to the old mindset of correlations that so much of Wall Street and even financial media subscribe to. It doesn't work. And it's based on correlations. What we did is say, look, what environment does gold do well in? And this is a little bit about macro, but think about this. If you understand what to look for, if you know what dots to connect, right? So what are the dots you connect with something like a long position in gold? And by the way, gold and the equities markets don't move inverse to one another anymore. We can see an environment where gold moves up and equities move up. So that throws an age-old correlation out the window. It doesn't work anymore. Okay, yet we still see so many folks on financial media talking about it. Throw it out the window. It doesn't work. It does work. Looking at real yields. You know how easy it is to find real yields? For those of you going, oh my gosh, Rog, what is that? The Department of the Treasury has a simple free page that shows you whatever the real yield is. And all you've got to do is look to see if those real yields are dropping throughout the month or rallying. And those are the kind of simple free tools that we use. If real yields are dropping, as they have been, it's very easy to be bullish gold. Okay? Those are the kind of things that I believe as traders, once you know what to look for, very simple, you can play causation. You know what causes something else to react. You know what the first domino is to make other dominoes fall. This is the stuff that exists beyond the charts, gang. For a long time, I was chart only. And that still is price and price charts. That's still a lot of what I do. But when you don't understand that narrative that exists outside the charts, you're going to get blindsided by things that the folks who do understand what's moving the markets in a bigger macro way and how they position early and better and effectively and confidently, when you can put the charts together, when you can put market trends a la Charles Dow with a little bit of macro together, you're pretty unstoppable because you're seeing all the facets of the market. Okay, and that really is psychology, gang. I'm not talking about doing a lot of number crunching here or being some sort of pseudo economist. They can't trade, by the way. We got a bunch of economists at the helm of the Federal Reserve, don't you know, right? I'm not talking about being an economist. What I'm talking about is understanding the trade story, okay? We talked about having a do not trade list. And for a lot of traders, I'll tell you, when you see those choppy blue, green, red markets, put those on the do not trade list. That's an excellent do not trade list. Stick with the trends. Stick with those trends with the dominant red, with the dominant green. That alone is going to keep you out of so much trouble. So know what markets and know what stories to sidestep. You know how to do that now because you're going to keep an eye on the economic calendar. And if non-farm payroll is coming out that first Friday and you don't want to deal with the volatility at 8:30 a.m. Eastern, great. You know now what to sidestep. You know that there's a big bus coming called volatility, way higher than normal. And you might say, you know what? Thanks, but no thanks. I don't want to engage in that market. So you know what to sidestep now simply by using an economic calendar. All right. Okay, so you guys remember this? I love this game. Pitfall. You guys remember this? Trading is like timing the swing on the rope just right, or balancing perfectly on the head of each crocodile. So there is a lot of timing, right? There is a lot to be said about understanding the blue and the red and the green grab candles. But It can be as easy as an 8-bit video game once you know what to look for. How many of you played hours and hours and hours of a particular video game until you realize, oh, the way you get across the crocodiles is to stand right there? I mean, how many times did you have to get eaten by one of these or fall in the water till you realize you just had to shimmy yourself right to the edge there, and that's how you leaped from crocodile head to crocodile head, right? This takes time to realize, you know, and that's what I want to bring to the table here. I've fallen into this a lot already for you, for me, right? And now I know the little secrets like, oh yeah, just kind of shimmy to the edge of the crocodile head and do it again and do it again, and you can get across safely, right? That's what 30 years will do, right? That's what falling into that water and getting eaten by the crocodile a lot will do too, all right? All right, so wouldn't it be helpful to have a clear, repeatable process? I want to go over a couple of the charts with you all, but what I want to let you all know is you're invited to join myself, Neil Yeager, many of you might know Neil, and David Starr for 2 days of live trading, our trade idea and alerts, all in a live market. So if you want to see the way in which I use the green grab candles, the red grab candles, the propulsion dots, the wave, and actually a handful of other tools, but those are really the foundation of everything I do. By the way, if I didn't mention this already, those tools are free. Okay, I'm not here to tell you now you got to go buy those tools. I've made those tools free since the moment I've been using them. I've been giving away the grab and the wave for free since the moment I developed them. So those are free tools. All right, but the best way to use those tools, I mean, I could give you those tools. I could give you a free saw, but I'm probably going to see you missing a few fingers the next time I see you, right? So what I want to do is give you these really powerful tools, but say, hey, look, come on back, hang out with myself, Neil, and David for 2 days, and I'm going to show you how we do this in a live market. So you can see how I make this analysis as the market's moving. The other thing that we're going to do, since a lot of you are probably looking at these strategies and tools for the first time, is after the active market hours, after the bell rings at 4 o'clock, we're going to have 2 bonus educational sessions, one with myself, one with David. David happens to be our resident Elliotician. David's, bar none, the best Elliotician I know. And he's also the creator of the Voodoo line. Some of you might already be familiar with the Voodoo lines. He's the creator of the Ready Aim Fire indicator. So David is a prolific and amazing indicator creator, but not to mention, and he's really humble about it, but he's a world-class Elliotician. So I'll be having a session to walk you through my tools. David will be having a session to walk you through his tools and his Elliott wave analysis. So that way you guys have a little bit more foundation built to move forward with these tools, okay? And you don't have to do anything. Just check your email for a link to join the room next Tuesday and Wednesday. I don't know why I didn't type in Wednesday. I guess you guys figured Wednesday comes after Tuesday there. But next Tuesday, April the 2nd and April the 3rd from 9:20 to 4:30. Now we do give you guys a quick lunch break in the middle of the day. Everyone needs to go feed themselves or go to the gym or whatnot. But from 9:20 to 4:30, we're going to take you through the day. Futures, I do look at some currencies. We'll look at I look at some sector ETFs and individual stocks, but we'll be together for 9:20 to 4:30 Tuesday and Wednesday of next week. And again, just check your email for the link to join. All right. All right. Let's talk about a few other things here. And gosh, we have a lot of questions. So let me grab those questions, gang. Let me show you a couple other examples of the blue and the green, or sorry, the red and the green here. All right, so this is a chart of crude oil, which has been really good to us. And folks always ask me, well, Rog, how do you know which direction to play? Once these red grad candles start plotting, I'm not going to be looking for buys, gang, not at all. We're going to be looking to get short and stay short. But look at the switch here. Look at the shift we saw. Red to blue to green. And yes, there are a few blue candles in the mix, but notice that predominantly we're looking at green grab candles. And in this environment, I want to be a buyer. By the way, we just bought crude for the second time this month. Well, actually, for some of you, second and third time this month on the volatility, gang. Talk about a unseen event to create some volatility. There was a tweet this morning that sent crude down sharper. I didn't know the tweet was coming. No way we could have, right? But because we had a plan, And because we had a directional bias, when the market sunk back down to our propulsion dots and our wave, we already knew where we wanted to get into the market. We didn't need the tweet. We were just waiting for some catalyst to drive it lower. Maybe it was going to be crude oil inventories. Maybe it was going to be a comment from OPEC. Maybe it was going to be a sell-off in equities. We don't know, right? Those are things we really can't know as traders. But if we know what level we want to engage the market at, if we know our pitch, we can recognize it sailing across the plate, we know to swing at it. Just that simple. Literally, just swing at that particular pitch, because now it's in our strike zone. And this is my strike zone. Can I enlarge this at all? Oh yeah, I can. Okay. That's my strike zone. That's what I'm looking at. I identify a number, I use a limit order, and I make the market come to me. This happened both in crude and gasoline today. And by the way, for those of you saying, Rag, I'm really not sure about futures, don't worry about it. You want to use the futures contracts to gauge the overall strength of something like crude oil, but you could also use the ETF USO to trade crude oil as well. So we have quite a few traders in the chat room that watch crude but trade USO, or watch the RBOB gas contract but instead trade UGA. So I'll give you these alternatives when they're out there, right? So you don't have to necessarily be an active futures trader, although most of our traders probably are, but some traders like to do both, right? Because sometimes, and one thing you'll notice is sometimes the options chain or the expiration flexibility on the ETF side of the futures contract is just going to give you more flexibility. Okay, so there's a lot that you can do once you understand what the main market is doing. And then you can take that out into, say, oil stocks. You know, right now I'm long Chevron, I'm long Phillips 66, and I'm long because I understand what the underlying futures contracts are doing. You understand what the commodity is doing, you know how it's going to affect the stock that's very much predicated on what the price of that commodity is, the demand, etc. Okay, so it really opens the market up a lot for you. Let me give you one other example like this, and this is Eli Lilly and healthcare. You might say, what does Eli Lilly and healthcare have to do with being a futures trader? Healthcare is one of the heaviest weighted sectors in a number of our broader market futures, S&P namely, right? So if you know what's going on with healthcare, not just tech, gang, a lot of people make the mistake of reducing certain markets to a single sector. Now there's usually 2 or 3 sectors that are affecting any individual futures contract. So one of the things we want to do is track those sectors. Well, if I'm tracking those sectors, I have the opportunity to play some of the heavily weighted stocks in these sectors. So think about how you can continue to sort of peel the market like an onion, right? And you can see all the different layers and opportunities once you know what the broader markets are doing. You just keep digging deeper and deeper. And I love this chart. And this is probably my favorite chart that I'm going to show you today here. This is by far my favorite. I've shown you a lot of great trades that we put on, but you know, it's the trades that we choose not to take that make a big difference. You know, a lot of folks feel, and I thought this was a really interesting thing out there to kind of calm the FOMO monkey out there. Think about this for a moment, and this is statistically valid. So I was on a podcast not too long ago, and the speaker before me said something that I kind of intuitively knew, but hadn't reminded myself of in a really long time. And that is, when you're thinking about your equity curve as maybe a longer term trader or even as an investor, the smoothness of your equity curve, right, is actually much more predicated on missing those crazy down days. People think that they're going to submarine their portfolio or their trading career by missing, say, the kind of rallies we've seen since January 4. And that is untrue. The kind of moves that destroy portfolios and traders are the kind of moves that happen in October, like the October 10th sell-off and the sell-off we saw subsequently in November, December, all the way into end of December, and then eventually early January where things turned around. It's those moves that destroy traders. It's those moves that absolutely obliterate equity curves. So it's not missing pockets of bullishness like we've seen sudden V bottoms. It's actually making sure that you understand when not to be in the market. Again, that do not trade list. In this case, the Russell here actually sold off and it looked like it should have been a great down day. But because we look at a price movement range, what we call the hourly PMR, something that I'm going to show you how to use really on day one when you're with us on Tuesday. So if you're curious, Rag, yeah, how do you miss a trade like this? How do you not get suckered, bamboozled into a trade like that? I'm going to talk to you about it, but what it is, it's an hourly price movement range. When this range exceeds a certain number of points, we know not to take the trade because it's probably going to chop for the rest of at least the early part of the session, maybe the remainder of the day. So hourly price movement ranges are something that I helped develop. I was an early beta tester for, and it's one of those things that I think is going to be such a needle mover that over the course of those 2 days that you're with us on Tuesday and Wednesday, if you pick up the value of these price movement ranges to understand volatility and to avoid certain kinds of trades, it's going to make such a difference, gang, in your trading. I couldn't even imagine trading without these numbers because I would have been short here and I would have sat through this. And because of that one number, which tells me on the Russell, by the way, if that opening range is greater than 12.5 to 13.5 points, do not take a momentum breakout after 10 o'clock. There's a very high likelihood that we're going to be stuck in a range. That's the number for the Russell, by the way. And I have numbers like that for every single market, including stocks that I trade. So very important to understand these, and we talk about these daily in the chat room. All right, so those are the charts that I've got for you, and then give me a moment here and we'll tackle some questions, all right? All right, so let me scroll up here. And again, I want to reiterate to everybody, I'll give you guys all the links on Tuesday and Wednesday. I'll give you guys all the links for the installation of the indicators for TradeStation, for Thinkorswim, even for TradingView. Okay, they're free tools. I'll give you guys all the links, as well as some supporting material to help you use those. And of course, you're going to see me use those in a live environment. All right, so for those of you that are wondering about the Darvis lines, oh yes, Simpler Trading has automated Darvis. We will talk about that more. You know, look, there's a handful of other things that I use. What I wanted to give you guys here today is the foundation, right? I didn't have Darvis levels the first 5 years that I was trading. I didn't have a number of tools back then, but what I did have was grab and wave and understanding certain moving averages, and those are the foundational tools that everything else really is built upon. Okay, so yes, we will be talking about Darvis, and by the way, gang, we're going to take this conversation into a live market on Tuesday. So this is just kind of a primer to let you know, the philosophy of what I use, kind of get you familiar with the tools that I use, and some of the things that we're going to see working in a live market Tuesday and Wednesday. All right. Let's see, are these indicators available for Ninja? Les, we have a handful of these tools. We're trying to work a little bit more closely with Ninja. I do have a handful of them. I do believe someone went off and created grab candles. I mean, I've made these freely available for years and years, actually decades. So I do think there are some selection with Ninja, but I don't have a lot. I'll be straight up, but we are working on it. Okay. All right. So again, on channels versus chops has to do with the color of the grab candles. You have chop when it's a rapid mix of the reds and the blues and the greens. You have a channel when it's predominantly blue. Okay, so the open house that we're having on Tuesday and Wednesday, gang, that's free. That's free. I didn't make that clear before. It's a free open house, gang. All right. What else do we have here? So for members, yes, gang, for members, the sessions are recorded every day. Members have access to the live archive, absolutely. You guys will have the link for the access in your inbox, gang. So the same email that you registered for this webinar, okay? You'll have the information to join David, Neil, and myself on Tuesday and Wednesday. You got it. Yep, free open house. And all the info will be in the email, gang. All right. Hang on, gang. Let me catch up with some of these other questions here. What are the lines? Oh, so some of the lines you're seeing on the charts, gang, that's volume weighted average price, or the VWAP that you're seeing on the 1 minute chart of the Russell. I don't use it across every single tool. You'll see like the gold chart, you know, we have the propulsion, the wave, the grab, etc. So that's something, you know, there's certain tools that we'll use selectively. That's one of them. The moving averages on the chart, sure, those are the 34 period exponential moving average on the high, the close, and the low. And let me see if I can't get you back to that slide that had that information. So it's the 34 period exponential moving average, one on the high, one on the close, and one on the low. And that's on the screen right now for you, my friend. The shading of the colors, you'll see it's also on here, green, blue, and red. If we're above the 34 on the high, it's green. I think I have that as well. Let's see. Yeah, if it's above the, there we go. If they're above the 34 EMA on the high, it's green. If they're below the 34 on the low, it's red. And if they're inside that, it's blue. And here's the explainer on the screen right now. So those are the moving averages. But the remainder of my moving averages, gang, I replace with simpler propulsion. Okay. And by the way, I do get from time to time folks telling me that they're colorblind or have different issues with the colors for whatever reason. These are the indicators. You can choose whatever color you'd like. So if you want to change the color, that is a feature within TradeStation and TradingView and Thinkorswim where you can change the colors. So if red and green doesn't work for you and you need to make them, you know, blue and yellow, whatever you'd like, absolutely. Okay. The white dots on the chart are actually the 200 period exponential moving average represented by simpler propulsion. So it's the cross that I use of the 8 EMA and the 200. So I use an 8-200 cross, and those white dots represent the 200 EMA. All right. Any comments on the micro E-mini M? I'm very excited about the micro E-mini because it's going to continue to make futures trading more affordable for more folks, allow them to take positions with multiple contracts, scale in, scale out. Very excited about it. I think it's going to be a monster hit. I think it's going to be a very popular contract. But we'll trade them the same way that we trade the current E-mini contracts we have now. So it's not like we're going to need a new type of market approach for them. All right. Do I trade intraday? Do I trade overnight? Absolutely. So Jonathan, great question. If you want to trade intraday and you don't want to deal with overnight margin, you're using, say, day trading margin now, or just want to eliminate the risk, absolutely. We day trade I day trade every morning. I'm pretty much done day trading. I was done taking most of my morning's trades by 10:08 today. So if you want to be in the market for a very short amount of time, you don't want the bigger picture risk, absolutely. Or if you want to manage the risk in a different way, you can actually use different asset classes. Some folks use the ETFs and take a small position with the shares. Others use options because you can quantify and limit your risk. So there's a lot of alternatives that we can share with you, Neil, David, and I, on how to control risk and minimize your exposure. But to your point, you're absolutely right. One of the easiest ways to minimize risk exposure is to minimize the time exposure that you have in the market. All right. Okay, so again, these tools are free, gang. I will show you how to get them on Tuesday during the free open house. All right. Chop versus channel, the width, Mark, the width of the range. And if you find a sideways movement dominated with blue, that's going to be your sideways market. And again, all of you that are asking about the indicators, come on over on Tuesday, again, during the free open house. I'll be walking through how to get those indicators for all 3 platforms, how to install, where to get them to install them on your platform and how I use them. All right. So it's a free open house on Tuesday. All right. What else do we have here? I think we've gotten through most of the questions. Blue candles are consolidation. You got it, Dan. Perfect. Why do I use the 34? Les, to make a really long story short, I had some major time on my hands, and I tested the series all the way up to 1597, 8, 21, 34, 55, 89, 144, and so on, all the way to 1597, which is actually a Fibonacci number. And I was looking for which setting would be most responsive and give me good dynamic support and resistance. And just to kind of get you to the punchline there, 34.1. 21 wasn't bad, by the way. 21 wasn't bad. 55 was too slow and too far away. 34.1. But 21 was the next best. Just, it's funny you mentioned 21. Yeah, 21 was the next best, right? So this pretty easily could have been a 21 EMA, but it ended up being 34. Okay. All right, gang. I think Gator, I'll talk about that on Tuesday, but Gator, I go right to the Department of the Treasury and I pull up their real yields. So real yields are just basically yields minus inflation. They track it. I don't have to do any math. I'm an English major. I don't want to have to do math unless it's adding up my profits for the day, right? But they do all the calculations for you, and I just read it right off the table. I'll show you on Tuesday for sure. Okay. When do I ignore the propulsion dots? JLP, if there are less than 3, I typically will ignore them. There are less than 3, unless they're red, but unless they're 3, I will typically ignore them. Will I be in Austin during the live event? Dale, absolutely. I will indeed. You don't have to buy any of these tools, Jason. They're all going to be free. Join us on Tuesday. I'll show you where to get them and how to use them. All right, gang. So thank you so much for your time. I don't want to hold you guys. I hope this kind of opened the door to a lot of the possibility to take maybe a current strategy that you're using now, tweak it a little bit, add some market trend analysis to it, and just take it to the next level. Again, all the indicators I'm teaching you do not supplant anything you're doing now. It will just supplement and add a high degree of accuracy. So I hope this was helpful. Thank you so much for your time. And as far as time frames, Ron, we'll talk about 1-minute charts out to weeklies, but normally I like short-term time frames or the daily. I'm either looking at daily or I'm looking at a day trade. That's usually where I like to operate, okay? Jasper, I appreciate the kind words. Thank you so much. All right, so I'll see you guys on Tuesday. All right. And you don't have to stay the whole day, right? Just come in, as time allows. If you need to come and go, no problem, okay? If you need to come and go, no problem. So just pop on in, make sure you ask the questions that you have. Make sure you stop on in to get the links for the installation of the indicators. I'll see you guys Tuesday and Wednesday, all right? Thank you, Dan. I appreciate that. Thank you very much. Did my mom tell you all to be nice? That's very kind of you all. I appreciate it. No, thank you all. I'll see you Tuesday, okay? All right, until then, gang, be good to each other. I'll talk with you soon.